Before you assume lower rates are coming soon, you need to know what the Fed just signaled. The Federal Reserve held interest rates steady, but the bigger update is that borrowing costs may stay high, and some officials now see the possibility of rates going up later if inflation does not cool down. That matters because one part of your money may benefit, like savings, while another part may get squeezed, like credit cards, mortgages, auto loans, or any debt with a high interest rate. And this is where people can get caught off guard. A higher savings rate might help your emergency fund, but that does not cancel out a credit card APR near record highs. This Fed decision affects people very differently depending on whether they're borrowing money, saving money, or trying to do both at the same time. So the big risk is making a money decision based on what you hope rates will do, instead of what rates are actually doing right now. If you're carrying credit card debt, shopping for a home, buying a car, or moving money into savings, this Fed decision can affect your real monthly payment, your interest costs, and your household budget. Now, the simplest way to think about the Fed's decision is that nothing changed today, but expectations changed. The Fed kept rates steady for the fourth time this year, and its statement said the economy is still expanding at a solid pace. Job gains are keeping up with the workforce, and inflation remains above the Fed's 2% goal. That means the Fed does not see enough weakness in the economy to justify cutting rates, and it does not see inflation low enough to relax yet. For your wallet, that pause can feel frustrating because a lot of people hear rates unchanged and think, okay, so why are my bills still so high? The answer is that unchanged rates are still high rates. The federal funds rate is not your personal credit card rate or mortgage rate, but it influences the financial system around you. Banks price loans based partly on short-term rates, inflation expectations, and borrower risk. And this is where credit cards probably hurt the most. Credit card rates usually move closely with the prime rate, and the prime rate tends to follow the federal. Since the Fed did not cut, card issuers do not have much reason to lower APRs. Some recent data showed the average APR across all credit card accounts at about 21% in the first quarter of 2026, and new card offers can be even higher. So if you carry a balance, this is the part to take seriously. A 21% APR means interest can build quickly, even if you're making payments every month. If someone has a $4,000 balance and only pays a little over the minimum, the interest can stretch that debt out for years. The practical move is not to wait for the Fed to rescue you. It is to call the issuer, ask for a lower APR, consider a balance transfer if the fee makes sense, or compare a lower cost credit union option. Now, mortgages are a little different. The Fed does not directly set the 30-year mortgage rate, but mortgage rates respond to Treasury yields, inflation expectations, and investor confidence. Bankrate's national survey has the average 30-year fixed mortgage rate around 6.55% this week, and another current rate tracker put it around 6.53% on June 17th. That is not as high as the worst moments of 2025, but it is still painful for buyers. A simple example makes this clearer. If you are buying a home, even a half-point change in the mortgage rate can move the monthly payment by a meaningful amount, especially when home prices are already high. So before you stretch to buy, compare the payment at today's rate with a higher rate too. If the numbers only work if rates drop soon, that is risky. And if you already own a home with a low fixed rate, this is another reason many people feel locked in. Also, savings accounts are the one place where higher rates can actually help ordinary people. The same rate environment that makes borrowing expensive can keep savings yields attractive. There are several high-yield savings accounts around 4% or slightly above, while the top nationally available rate at 5% for accounts that meet certain conditions. The catch is that big banks often still pay very low rates, so you may have to move your emergency fund to actually benefit. But do not chase a savings rate blindly. Check whether the account is FDIC insured, whether there are balance limits, monthly fees, direct deposit requirements, or promotional rates that can change. If your emergency fund is sitting in a traditional savings account earning almost nothing, moving it can be one of the simplest ways to get something back from this high rate period. It will not fix inflation, but earning 4% instead of a fraction of 1% is real money over time. Now, auto loans are another area where the Fed's pause means buyers should stay cautious. Current auto loan data shows a 60-month new car loan around 6.92%. And it has been reported that the average new vehicle APR at 6.9% in the first quarter of 2026. Used car rates can be tougher, with data showing around 10.4% for used car loans in May. The tricky part is that dealerships can make the monthly payment look manageable by stretching the loan term. That can help your budget this month, but it can also keep you paying interest for longer and raise the total cost of the car. So before you focus only on the payment, look at the price, the interest rate, the loan length, and the total interest paid. A cheaper monthly payment is not always a cheaper car. Now, why is the Fed doing this if people are already stretched? The central bank's goal is to bring inflation back toward 2% while also supporting maximum employment. The June projections showed median PCE inflation at 3.6% for 2026, higher than the target, while unemployment was projected at 4.3%. In plain English, inflation is still too high for comfort, but the job market has not weakened enough to force the Fed's hand. There's also a policy debate underneath this. President Trump has wanted lower rates because cheaper borrowing can support business investment, housing, and consumer spending. But the Fed, now led by Kevin Warsh, chose not to cut and signaled caution because inflation is still elevated. Reuters reported that 9 officials now see a rate increase by year-end, while Warsh did not submit his own rate projection. So before you make a money decision after this Fed meeting, separate your needs from timing bets. If you need to pay down high-interest debt, do not wait for a perfect rate environment. If you're buying a home or car, run the numbers at today's rates and leave room in your budget. If you have cash savings, make sure it is earning a competitive yield. And if you're investing for retirement, remember that one Fed meeting should not make you abandon a long-term plan. And one more thing to keep in mind is that you do not have to predict the Fed perfectly to make a better money decision. Most households do better by asking simple questions. Can I afford this payment if rates do not fall? Am I paying high interest on debt while my savings earns very little? Do I have enough room in my budget if prices stay higher for a while? Those questions may sound basic, but they can protect you from making a rush decision based on headlines. The takeaway is this: the Fed did not make borrowing cheaper, and it did not promise relief soon. That does not mean you panic. It means you plan around the rates that actually exist. Pay special attention to variable debt. Shop carefully before taking on a new loan. Keep your emergency savings working for you, and watch the next inflation reports because those numbers will shape what happens next. For most households, the best move right now is not a dramatic move. It is a careful one. Thanks for being here, and I'll see you next time.